here meeting Tom Stokes, the investment director here in London. Desire Wealth Management has the opportunity to ask you some key questions, questions that were asked throughout the year with clients. Significance of that is the fact that AVIVA are key to our investment proposition. Most of our clients have assets with yourselves, and it's an opportunity for us to really hear it from the horse's mouth, as it were. So, Tom, if you're okay, we'll run through the questions.
Definitely, yeah, and you're very welcome. Very welcome.
Thank you. So, the multi-asset plus funds are a key component to our investment proposition. They feature in a number of our client portfolios. How significant is that particular fund range to AVIVA?
Very significant is the answer. So, to give you a bit of a background history of AVIVA Investors, we're the fund manager, the asset manager for AVIVA. So we've been managing multi-asset funds for over 45 years. It's a really long time. And a lot of the resource in AVIVA Investors is funneled through into the multi-asset team. So, I mean, you're speaking to me today, but there's a team of over 45 people. So it's not just me. There's a lot of other people that are working on running multi-asset funds. And they're collectively responsible for nearly 100 billion of assets in multi-asset funds. But the funds that you're talking about, they're the flagship funds. They're our most important precious babies, the multi-asset funds, the plus funds.
So with regards to the holdings within the portfolio, how many investment positions are there within the multi-asset plus funds 1 to 5?
So if you're thinking of the individual securities, so your Microsofts or your Coca-Colas or Vodafones, there is literally thousands of individual securities on companies, and then bonds and government bonds, so thousands. So very, very diverse portfolio. And to try and make sense of that, because you can't just blindly invest in thousands and thousands of securities. You've got to sort of have some sort of construction process behind it. So the way we allocate is in 3 different buckets: a growth bucket, a defensive bucket, and an uncorrelated bucket. So the growth bucket is the assets that you think will give you most growth potential. The defensive bucket is there to protect you when the markets can go sour, which happens every now and again. And then the uncorrelated bucket are assets that are trying to do something a little bit different and perform differently to traditional equities and bonds. So we then allocate between those different ones. So when you move up to higher risk funds, there's more in the growth bucket, and when you move to the more defensive funds, you have more in the defensive and correlated buckets.
So concerning alternative investments, what position do those investments hold within the portfolio, and what benefit do they have to our investors?
Yeah. Alternatives can have a really important part to play. So traditionally, when you're looking at investing, people think about investing in companies, so equities or bonds, government bonds or corporate bonds, but there are other alternative assets that you can look at. So within MAF Plus, we currently hold absolute return funds. They're sort of solutions that are trying to deliver a return in all weather conditions, different market conditions. We're looking at commodities, so things like physical gold. We're looking at asset-backed securities. We're looking at things like convertibles. So a real mixture of different assets. And they're all there trying to do something different to equities and bonds. And last year is a great example of why you might want to hold alternatives, because you saw equities down about 8%, global bonds down about 15%, but our uncorrelated bucket of alternative assets was up. It was positive. So the absolute return strategy was up about 6% when those markets were down. So it can be quite important as a way to sort of diversify the portfolio and create a bit of balance when you can't rely necessarily all the time on your equities and bonds.
So with regards to the FTSE 100, for example, and the influence that seems to have within the portfolio, yet clients are often making comparisons to that index. How much attention should they be paying to that particular index when the AVIVA fund is a global investment?
So I guess the best place to start with the answer there is that if you look at the FTSE 100, what is it? Well, it's the 100 biggest companies in the UK. That's what it is. But we're not investing in the FTSE UK, the UK equity market only. We're investing across global markets, and not just equities either. We're investing in equities, bonds, and alternatives like we just mentioned. So you can't really compare apples with apples. Our portfolio is a global suite of lots of different asset classes. It's not just UK equities. So that's the first thing. It's not really an easy comparison. But it does kind of beg the question, well, why do we run mandates more globally rather than UK centric? Well, there's a few answers to that question. So one is, if you look at the UK equity market, it actually represents only about 3% of all the companies around the world. So it's actually quite a small part of the wider investment universe. It's typically not performed particularly well over the longer term versus more global assets. And if you think about the typical investor in the UK, before they even start thinking about investing in their ISA or the pension, they probably already have a lot of UK risk already, whether it's the job in the UK, their house, which will be one of their main assets, which will be in the UK. They probably have savings in their UK bank account as well. So when it comes to pensions and investing, we think it definitely makes sense to think more outside the box and more globally rather than being so narrowly focused on the UK market.
So considering overseas investments and markets of influence, I guess China continues to get a lot of attention. They are obviously a key country in the Far East, but also they're a very difficult country to invest in. The growth of China and the region could potentially be quite beneficial to a UK investor, but it doesn't come without risk. And China specifically, with them engaging with military maneuvers around Taiwan. How does AVIVA expose themselves to China and also control the risks that might be as part of as that investment?
Sure. As part of a diversified portfolio, we definitely have exposure to China in there, but we think of it as more emerging markets, so all the countries that kind of associate in emerging markets rather than your sort of developed markets, which would be Europe, US, and UK. And you just can't avoid it. So it's a huge part of economic growth. About half of economic growth is from emerging markets. China is the second largest economy in the world, so you just can't decide not to invest. In many respects, if something goes wrong in emerging markets, then you're going to feel some pain in Europe and the US and the UK as well anyway. But we quite like emerging markets because you've got that diversification aspect. So if you think about some of the key risks we're facing today, we're having economic growth that's slowing down in Europe, UK and US. You've had a bit of a mini banking crisis wobble at the beginning of the year. And when you think of China and emerging markets, they're relatively sort of insulated from that noise. So it's a nice way to sort of access other markets that are not being determined by some of the same key risks that we're seeing in other markets. But of course, there are risks attached to emerging markets, different risks that you would see in more developed markets. So you need to be more, monitoring the situation more closely, and that speaks to why we are active managers. So we're constantly reviewing things, constantly reviewing the relationship between China and US and China with Taiwan. And when things change, we can adjust the portfolio to kind of take into account how things change in the markets.
Tom, you've kindly given your time here today, and as the investment director, I'd imagine you're an extremely busy man. Often when I think about portfolios being managed, that you're sitting in front of a screen with red lights flashing constantly and you're having to make investment decisions on a minute by minute, hour by hour basis. How does the investment proposition actually get carried out, and how active are you with the investment portfolio?
Very active. So we're monitoring the portfolios every day. The investments, that's the main job of the investment team, is to think about where we're allocating people's money and where the risks are, and make sure that we're being rewarded for those different risks. So that it really is a daily thing. And if something changes in the markets that we need to get ahead of, then we can make a change to the portfolio in 30 minutes if needed. So very, very active in that regard. But yeah, it's something that we constantly monitor all the time.
So although investment pension portfolios are medium to long-term investment portfolios, comparisons are often being made to interest rates, cash savings. Obviously interest rates have gone up, and cash on deposit is earning more than it was 12-18 months ago. Can the assets that you hold and the multi-asset funds outperform cash over a 24-36 month time horizon?
Yeah, so and I'm not just trying to promise anything too much there, but to me this speaks about the difference between saving and investing. So saving, putting your money in a bank account, that's great, you're going to get an interest rate, and good news, you're going to get more interest than you would have done 12 months ago. But what you do expose yourself to is inflation risk, because inflation, as we know, is pretty high, and it erodes away the value of that capital secretly. So the cost of it going up means that your cash can't really buy as much as it maybe would have done before. Now that investing is different. So investing is a longer term, but it's trying to deliver returns that will get better, beat inflation over the longer term. There may be short-term periods where you might have been better in cash than investing, but longer term you get that benefit of accumulation and a return that's better than cash. And that's certainly been the case historically. So if you look at the numbers, equity returns on average have been about 6%, where for cash returns have been about 0.8%, both after inflation. So to grow your wealth longer term, investing in equities would have delivered a much better outcome than in cash. But yeah, there's a big difference between saving and investing. If you want to have returns that do better than inflation and grow your wealth in real terms, then investing makes sense in the long term.
Tom, thank you very much for taking the time out of your busy schedule to answer the questions on behalf of Desire Wealth Management and our clients. It really is very useful for us to have, from an investment insight, your answers to the questions that have been posed. Thank you very much. No.
It is something that's a daily management. What's the train of thought there?
So the
completely lost the train of thought.
Maybe my question was too long. So a comparison I have with clients throughout the year, and what we'd like to do is get, I guess, the take from AVIVA. Stop. Okay. Got to stop then. Okay. So, no, I'm not going to start with so, am I? Thank you very much. We really do appreciate you giving us the opportunity to come in and present our questions to you, and we really appreciate your time.
No problem at all. Thank you. Thanks, Wesley.
Thank you.
Thank you. Should we do it again?